Okay, so this is the chapter 14 of this course, financial statement. So uh, I encourage that everyone should uh, have a willing to learn this, especially if you haven't taken the course of accounting. Okay, but my presentation today is something that is so basic. So it's okay. You just can listen to this, and I think because this is just the basic one, it's not really difficult. So you just pay attention, and let's say this is just the beginning for you to recognize accounting, maybe if you never hear about it. Okay. Okay, so I want to tell you that the existence of financial information will help you to understand your business. So in this chapter, you are going to understand the financial statement. And again, I tell you that this is the basic one and something you will create in your business is the very basic one. Okay, in financial statement, we have three things, and these three things are common in financial statement. There is balance sheet and income statement and cash flow statement. So uh, you have know these three terms in order to understand the financial statement. Okay, so this is a balance sheet. So everyone, maybe even though you ever learn accounting or you haven't learned it, I think you ever hear about balance sheet. Okay, so the keyword in here is balance. So what do you find in this balance sheet? So in this balance sheet, you will see the distribution of assets, liabilities, and net worth. And what is assets, what is liabilities, and what is net worth. So just pay attention that assets, yeah, the definition of assets, you can guess what is the definition of assets and liabilities, and also the net worth. And now we want to define them uh, one by one. Okay, we want to define the terms in balance sheet one by one. So balance sheet is also called as statement of condition. Okay, this also called as statement condition or the financial position. Okay, the statement of financial position. So if you hear like uh, the statement of condition, they mean it is balance sheet, or some people in the company will talk about the statement of financial position. It means they are talking about balance sheet as well. Okay, so there are many ways how to talk about the balance sheet, people will say it as a statement of condition, or people will say it or as the statement of financial position. So here is the formula to show the relationship between assets, liabilities, and net worth. So here is the formula to show the relationship of them. And these three things will form the balance sheet. Okay. So we have assets here, and in the right side, we have liabilities and net worth. And net worth sometimes is equal with equity. Some people will write, or some books will write the net worth with equity, or just they write it net worth, or the type it like this way: net worth, parentheses, and equity. Okay. So what is assets? You can define in your mind now about assets. What is assets? So later on, we will check on it, your definition into the context in the book according to the expert. Okay. I give you time for a while and define the liabilities and define the network. I let you 1 minute to make the definition of assets, 1 minute to make the definition of liabilities, and 1 minute to define the net worth based on your understanding. You can type it down or you can write it down, and later on we will check that. Okay, so now you have the definition of this term. Let's check them one by one. So what is assets? So these are the keyword in assets, okay? Things owned by the business, and they can be tangible, such as cash or buildings, or they are intangible, such as goodwill, okay? So you can check whether your definition is alike with these words, okay? So assets divided into these categories, okay? First one, current assets, okay? So current assets is the form of current assets is something like cash or anything that will be converted in cash within 1 year. Okay, within 1 year. So they give the time limitation. Okay, such as marketable securities, accounts receivable, and inventories. Marketable securities within 1 year, and accounts receivable in 1 year, and inventories in 1 year. For the project that you do in this course, it seems like, yeah, you don't have marketable securities, and accounts receivable, of course, you have, and inventories also you have, and cash, you also have the cash, okay? So this is the current assets. So now you can start to identify the current asset in your small business. So you just write it down in order to help you to identify your current assets. So you see here you have cash, and you have accounts receivable, and you have the inventories. So especially for inventories, you can write down the name of your inventories right now, your small business have right now. In order to help you to apply this definition into your financial statement of your small business. Okay, I remember that your project don't really have, your small business don't really have many current assets. Okay, and next one is a fixed assets. Okay, from the definition, you can see, you can identify what is the thing included in the fixed asset. Okay, so these fixed assets also called long-term assets. This one is more permanent item. Okay, so they are not in 1 year compared with current asset. They have the time limitation for 1 year. But for fixed asset, they are is something that is permanent, more than 1 year. So the example of fixed asset is building, and also the major equipment. For example, if you run an agriculture business, maybe you have the technology such as a tractor or something that a room for storaging. Okay, so that is your fixed asset. From the machine, maybe it will be stay longer for 3 or 5 years, or maybe for 10 years. And for the building, maybe they will be staying uh, for 10 years or for 20 years, 20 years. Okay, so that is a fixed asset. Now you can identify the fixed asset you have in the small business. Yeah. Something that you can use for a long term. Okay, more than 1 year. So here, because we are going to make the statement, and in accounting system, we have a term like balance and credit. And for the assets at accounting system, we record them as debit balance. Okay, so in this part, I will show you how to write balance and how to write credit and what are inside the balance. Okay, balance system and a bit balance system. Okay, pay attention that in this accounting system, you have to remember that assets recorded as debit balance as debit in balance sheet. Okay. The second term is liabilities. You can check your definition, the liabilities, and we will define them now. So the liabilities is what business owes. Okay. So if you borrow money, then you have to pay them. That is your liabilities. Okay, you owe something to people. That is the simple definition of liabilities. So you can check your definition. Okay, so liabilities is also divided into the categories. First, it is current liabilities. So those that must be paid within a year or less. Okay, current liabilities. The time limitation is the same with the time limitation in the uh, current asset. That is within 1 year. Okay, in current liabilities, they say or less. The sooner you pay for your liabilities, the sooner your company will be better. Okay, so the kind of liabilities is accounts payable, such as inventories, rent, utilities, and so on. Okay, maybe you rent the land, then you have to pay that every year. You have to pay the rent every year, and also some kind of inventories as well. And then you also in the current liabilities also accrued wages. Okay, so you have to pay that within a year or less, or maybe every month, something like that. Okay, and the current portion of longer term notes payable. Okay, the current portion of long-term notes payable, something that is stated as long-term, but you have to pay that currently. Okay, so that is called current payable, current liabilities. And then long-term liabilities in the fixed assets, they also defined by the length of the time, such as long-term. But here in liabilities, they say it directly with long-term liabilities. Okay, it is include items that do not mature within 1 year, such as bond loans, mortgage, or other longer term obligations. Because they say long term, it means everything here is uh, uh, more than 1 year. Okay, so that is how you will differentiate between current and long-term liabilities. Something that is have to be paid within 1 year or less than 1 year, you have to say it as current liabilities. But something that you have to pay more than 1 year, you can say it long-term liabilities. Okay, so you can check. Oh, okay, you only define the liabilities before. And at accounting system, liabilities are recorded in the accounting system as credit balances. Okay. Okay. So next term is net worth. Okay. So this is the difference between the value of the assets and the value of the liabilities. Okay. Let me tell you where this is come from. I will share another things like here. Previously, we have the formula like this. Assets is the liabilities with net worth. Also, we say it as equity. Okay, but now we want to define the net worth. So the definition in this part say that net worth is the difference between the value of the asset and the value of the liability. So this definition comes from the formula. Okay. So here, this one move liabilities move to the left, so it becomes assets. We move it here, so it becomes assets minus liabilities. So that we call net worth. Okay, so that is how they define the net worth. Okay, so net worth is the difference between the value of asset with the liabilities. Okay, so you can just define them according to the formula. Okay. And then I want you to know that why it is called balance sheet. So the important key here is balance, because the total assets will always equal the total liabilities and net worth. So, okay, so the net worth will be in the accounting system. Also, they will be put in the credit, okay? So the meaning of the balance sheet is then the value in the credit side and in the debit side and credit side have to be the same. That is why they are called as balance sheet. And next example, let's go to the example here. Okay, so let's suppose that a new business was started with the owner's saving of $100,000. Okay, so we see here the asset. Which one? The 100,000 name in the asset. Now they have in the cash 100 thousand dollar, right? So that is their current assets. Okay, so because debit the debit balance and the credit balance have the same, it means the net worth as liabilities plus net worth have to be the same with the cash. Okay, so their net worth right now is $100,000. Okay, so that is the simple explanation of balance sheet. So this one is debit balance and this one is credit balance. So they have the same. Okay, so they are balanced here. 1,000, 100,000 and 100,000. For the current asset, their name is that this is as a cash, and from the liabilities and net worth, they call it as net worth. It is not liabilities because they don't borrow money from another one. Okay, so that is just their net worth. Okay, so you can process this information for a while. So they have 100,000 right now, and it goes to the cash, and cash is something that have to be used within 1 year. Okay, so that is why we call them as current assets. Okay, they have something they have, something they have, something the company have, we call it as assets. And we put them as current assets because it is a cash that something can be used for 1 year or less than 1 year. Okay. Let's see to another example, but still the same amount of money. Okay. So the owner then decides to stock her store. Okay. She purchases $50,000 of merchandise as her inventory, but pays only $25,000 in cash. Okay, so it means the owner want to buy the merchandise, the value is $50,000, but she pays only $25,000 in cash. So it means that she reduces the cash for 25 $25,000, and the rest $25,000 she will pay it later. Okay, you stay here and promises to pay the other in 30 days. Okay, so it means she has account payable that have to be paid less than 1 year. Okay, because she will pay this the next day, the next 30 day. It means she owes people who sell the merchandise for 25,000. So it means this is the liabilities, okay? Because the term is just 30 days, it means less than 1 year. So it is called liabilities as current liabilities. Okay, this is the explanation. This transaction establishes a new item called accounts payable. What is the accounts payable? This $25,000 that the owner have not paid yet, okay? Which is placed under the category of current liability because the bill must be paid within 1 year. So now we have the additional item into the balance. Previously, we only have current asset and also net worth. Now, because they use some of money to buy the things, then we have additional items. Okay, so let's see this. How they can have more than 100,000. So this is the explanation. From the previous, we have the cash 100, but now they already spend some of the cash for 25,000. Okay, so now they only have the cash for $75,000. And they have account payable, they have to pay for 25,000. And now they have additional item to their current assets. Okay, they have the merchandise now. 50 for the value is $50,000, but they only have paid for 25,000, but the value for the inventory that already in their company is $50,000. So we put $50,000 here. Okay, so let's go to the current liabilities. They still have the net worth for 100,000, right? Net worth. So the net worth is the cash they have and the number of the inventory that they have paid. That is the net worth, their net worth. And now they have account payable. Okay, so what is this net worth? This net worth now already divided into two categories. They are the cash, 75,000, and also the inventory that they have paid for the value $25,000. So that is why 75 plus 25 is 100. And now they have additional item that is account payable. Account payable, they have to complete the payment for 30 days to come, the value is 25. So now they have the current liabilities for total liabilities and net worth. Okay, so net worth is 100 and liabilities is 25. So the number of the value of current liabilities is the liabilities plus net worth is 125 thousand. So balance with this side. So this side is the debit balance and this side is the credit balance. So they have to be the same. Okay. Okay, you can process the information. Okay, so that is the first thing about financial statement, about the balance sheet. So in the balance sheet, you will find assets, okay, the company, the things that company own, and liabilities, the things that company owes, and the net worth, or that is same with equity. Okay, and the equity is the difference between assets and liabilities. Okay, we put assets in the debits balance, and we put liabilities and net worth in the credit balance. Yes, so why is it called balance sheet? Because when we write down the transaction, all the transaction in the debit balance, in the credit balance, have to be balanced, has to be the same. So they are called as balance. Okay. So now let's move to another term, that is income statement. Okay. So income statement shows whether the business is making a profit or losing money. Okay. So the word is income, income. Okay. And they it has like statement to emphasize that this company get a profit, or this company get this company doesn't get any profit. Okay, so you can see your definition. How do you define the income statement before? Okay, so income statement, so also called as profit and loss statement, or some document maybe will write it as P&L, or some people maybe will say in the conversation as statement of operation. Okay, the statement of operation. So if you see these three terms, so it means it refers to income statement. Okay. So as have been defined in the beginning, in the definition, the income statement to show whether the company making profit or losing money. Okay, so the performance of a business over a period of time, typically a month, a quarter, a semi-annual period, or a year. Some people will make the income statement for income statement used to be recorded within a month, a quarter, a semi-annual period, or a year. Okay, so people never make the income statement for the transaction after more than 1 year. No, but always in a month, a quarter, a semi-annual period, or a year. Okay, so that is the income statement. So the formula for income statement is revenue minus expenses. We call it as income. And where do we get the revenue? Okay, so the revenue is the value of the number of our production times with the price. Okay, for example, here I will make it in this one. So revenue is price times with the production volume. Production volume. Okay. So this is the how we find the value of the revenue. For example, if we have the production volume of tomato is, let's say, the production volume is 500 kg, okay, and the price in that moment is Indonesian rupiahs, let's say 8,000 per kgs. So the revenue is price. The price is 8,000 per kgs times the 500 kgs. Okay. So how much is the revenue? So this one is the revenue for million Indonesia rupiah. Okay. So because so they only left the revenue, right? The rupiahs. Okay. So they have 4 million rupiahs for their revenue. Okay, so that is how we get the value for the revenue. Now we go back to the presentation. Okay, so the income is the revenue minus the difference between revenue and expenses. So expenses is the cost production. Okay, so the money that you spend to buy the production input, such as fertilizer, pesticide, and seed, maybe, and your labor wage. Okay, so after you divide, for example, previously our revenue is 4 million in the example, and let's say the example, the expenses is 2 million. So your income is 4 million minus 2 million. So your income is 2 million. So I will make it here again. So this is the revenue. So after you calculating them all, you find that expenses is 2 million, okay? This can be, these expenses comes from like buying the fertilizer cost, for example, and pesticide, or maybe labor payment for one planting season, okay? Labor payment and etc. Okay, so now you have the income. So let's income is the revenue minus expenses. So you have the income for this. Okay, so that is your income, because you get money and the value is positive, so it means you get profit. Okay, so that is the income statement. I'm sorry, I lost my presentation. Okay, so this one. Okay, the expenses is the production cost. Okay, so still divided into some categories. They have variable cost, fixed cost. Let's see variable cost. So variable costs vary according to the sales activity of the company. So if you are agriculture business, so your variable cost may be something that related to agriculture, just like fertilizer, pesticide, and seed. Okay, and they are usually listed in the cost of goods sold section of the income statement. Okay, if there are no sales, the variable cost will be zero, of course, because there is no cost to produce the output. Okay, and fixed cost occurs despite sales levels, and they include such things as rent and insurance. So remember, if you have the rent and also insurance, you put them into the fixed cost. If there are no sales, this cost will still occur. For example, you rent the land, but you don't do agriculture activity and you don't plant any kind of crops, but you have to pay the rent cost to the lender, okay? And the income statement always begins with revenues from sales, okay? So always, if you are asked to make the income statement, always start it with revenues. So this one is the example. So we want to make the income statement started with sales. And then this is the cost of goods sold. It means the production cost to to produce these goods. Okay, that is called as cost of goods sold. It has expenses. Okay, what is the expenses in order to produce these goods? They have salaries, they have freight, they have bad debt, they have utilities, they have depreciation, they have insurance. So here they have the expenses for variable and fixed cost. Okay, this one is like depreciation is from the fixed cost, the utilities is from the variable cost, and also miscellaneous. And they have the number of expenses is the value of expenses is 226 $226,200. Okay, and next we see the total expenses. Okay, total expenses. Okay, this one I have mentioned it, and other income. Other income such as income taxes. Okay, it means the expenses for other income. Okay, so they have the income taxes 500 and for 5,400. So the net income they have is 72,900. Okay, so that is the net income of this company. Okay, you can process the information. So let's go to the last statement, that is cash flow statement. It shows the liquidity or cash situation of the business based on the cash inflows and cash outflows. So the keyword here is cash flow. Okay, not only cash, but the cash flow itself. So this is the sample of cash flow. Cash in sources. They've put here forecast annual budget, forecast January and February. Okay, so cash in, they say it as sources, where they get money to be put in the cash. They have sales, they have interest received, they have contribution from owners, and they have borrowed money. Of course, they will have liabilities, right? But this borrowed money come to their cash. Okay, the number is here, and the value for cash in is 80,050 in forecast for annual budget. In forecast January, they don't have cash sales and they don't have the interest received. Okay, so they only have 60,000. And in here, in beginning cash balance, they have 39. Where is this 39 taken from the ending cash balance in forecast January? Okay, so cash out, what is their expenses during this time? So they have to prepare for inventory, they have to pay for operating, they have to buy the furniture and fixture, they have to maintain or maybe to buy the new equipment, they have to pay the income taxes, and they have to pay the distribution fee. Okay, so in this time they have 78,000, here 21,000, and here only 12,200. So ending cash in the forecast annual budget is 2,050. In January is 39,000, in February is 26,800. There is ending cash balance for each period. Okay, so this one is the cash flow statement. You will present the cash in. It means the money come to your cash, and the cash out. The money goes out from your cash. Okay. So that is the income statement. I will show you a little bit about the how to make the balance sheet, because that is the part of your exercise. Okay. So for example, for the balance sheet, previously we have like here we put it as transaction, and we put here debit. Remember that debit balance is the things that we put all assets in the debit balance, and we put credit in the for the liabilities and net worth. I want to show you how to make the balance sheet. So let's say the transaction. The transaction is for example, they have money come to their cash, is the number is 100,000. So we put here cash. Okay. Cash we put in the debit balance. Okay. So we have here 100,000. Okay. And then the transaction for this case, because we have to have the same place with the same value with debit and credit. That is why they call it as balance. So because they have 100,000 here, so it means for the credit side here, for the liabilities and net worth, or we can make it as equity. We put them in the credit balance, so the number is the same, 100,000, right? So this one have to be balanced. Okay. And then let's see for the next transaction. They buy for the things, and then they and then they less the money, right? So maybe we can, because they buy things, it means that their asset have increased. Okay, let's say the asset increase, they buy the fertilizer, and it here then the value, let's say like 30,000, and where they get the 30,000, they get from the cash, because the cash is reduced. Then we put the value here, 30,000. Okay, so this is how you will make the your balance sheet for your small business. So when the cash being deducted, we put the value in the credit, and when the cash is increased, we put the value in the debit. When the number of your inventory is increased, we put the value in the debit. Okay, so this is the example of your balance sheet. And for the income sheet, that is clear enough that you have to start it with the revenue at first. Okay, so you don't put the revenue, you started with the sales, sorry, and you don't put the sales at the end, but you always have to put the sales in the beginning, because you will deduct the income is the difference between the sales and the expenses. So you have to put sales in the beginning of your income statement. And for the cash flow, for the cash flow, you will present the value of cash in and the value of cash out. So we can see how healthy is your company, how healthy your company is. Okay, so that's for this chapter. Thank you for your attention.